This is Javier Flores with Keller Williams Realty. Here's Bob Brenner with Guild Mortgage on this week's Mortgage Market Update.
Hi, Bob Brenner, Certified Mortgage Planning Specialist, Guild Mortgage, with this week's weekly mortgage rate wrap-up. Anyways, rates have improved a little bit this week, in large part because the stock market has been selling off considerably, and we've had a flight to quality. Also, there's obviously international issues still remaining with Ukraine and China and so on and so forth. All good news for the bond market, despite positive economic reports that in a normal market would cause rates to move up. But we've had an improvement. Standard 30-year fixed rate loans are in the mid 4.5% range, depending upon your credit score. Government loans are about 4.25%. These are all at 0 points, by the way. The high balance and jumbo loans ranging anywhere between 4.5% to 4.75%. Will that continue? Who knows? If the stock market rebounds next week, if the international concerns dissipate, we're going to see rates probably worsen slightly. Again, as I said last week, no one's anticipating that rates are going to be skyrocketing anytime soon. Let's go to the charts here real quick and give you an overview. Well, it's been an eventful week in the bond market, and specifically in the mortgage-backed security market. As you can see here, as prices have improved, everything's in green. Rates have declined, or pricing has improved as well in terms of cost of getting a loan, or both. Standard 30-year fixed-rate conventional loans are in around the 4.5%, 4.375% range at 0%, 0 points. VA and FHA loans are in the low 4s, 4.25% at 0 points or better, and jumbo and high balance loans are in around 4.5% to 4.75%, again at 0 points. We've seen a lot of new interest in checking out the 7 and 10-year loans. Reason being is they're below 4%, and if you're going to be in the house shorter than 7 years, the national average for home ownership, by the way, is 7 years or less, it's something to consider. Clearly, you can still get rates, as I said, below 4% at 0 points with those types of products. So what we've had here today, as I said, or this week, is an improving bond market, largely as a result of international concerns with still Ukraine and Chinese economy. So money's been moving out of from overseas and into the bond market, as well as some sell-offs this week in the equity market. Stock market is sold off a number of times this week. So money is poured out of those markets and into the bond market, and specifically mortgage-backed securities, and it's helped the rate picture improve. So what's on the plate for next week? Well, again, if the stock market improves, we're going to see things correct. I don't know if it'll be as bad as this, but we will see rates creep up a little bit and the cost for getting a loan increase slightly. Again, no one's anticipating rates to be skyrocketing anytime soon, but it's, I think, reasonable to expect by the end of this month, what was at 4.5% today is going to be about 4.75%. Reason being is there's still very strong economic reports coming in that, despite the lingering international concerns, would suggest that rates should be moving up. For example, the Michigan Consumer Sentiment Report was released today. It had a little bit of effect on the market, but it came in much stronger than anticipated. Also, the Producer Price Index, that's the cost of goods if you're a business, business-to-business situations, that's increased a lot. In fact, so much so that it is, if it is unadjusted, is inflationary. So we're going to see rates creep up again over the coming weeks and months to come. So anyways, if you have any questions, feel free to give me a call at 805-427-3538 or shoot me an email at bbrenner@guildmortgage.net. Look forward to hearing from you. Make it a great weekend, and talk to you next week.